Hello, and welcome to another episode of Everybody Counts. It is Malone Bailey's official podcast. I am very excited to be here today. We have a great topic to discuss. And before we jump into our topic, I thought I would give our listeners just a very brief overview of Everybody Counts. This is a podcast that features a variety of different voices on a variety of different topics. So you'll find that it covers everything from technical topics, whether it be SEC or FASB updates, including also now some tax information, everything from that to practice management topics, retention topics, communications topics, just a little bit of everything. So we invite you to always tune in. The conversation is versatile and everybody's input counts. So today we are going to be talking about the new guidance on revenue recognition. And this is a hot topic because the clock is really ticking. It will go into effect January 1st of 2018. And I'm really excited to be joined today by Leah Gonzales. She is one of our audit partners. Welcome, Leah.
Thank you, Caroline. I'm so excited to be here. I feel like it's only yesterday when I did my last podcast.
I know. So this is not your first rodeo. You've done this before, and hopefully it was a fun enough experience for you that you're back for round two. So, Leah, why don't you give us a quick overview of your background?
Sure. I'll be happy to do that. As you mentioned, I'm an audit partner here at Malone & Bailey. I've been with the firm since 2008, and I've actually been with public accounting for more than 20 years now. So I feel like I'm a dinosaur on this industry.
Now you're a seasoned professional for sure. Okay, well, thank you, Leah. Thanks for taking time out of your busy schedule to be here. I know that you've got a lot going on. You're involved with so many different parts of our firm, whether it's our mentorship program or our Next Gen Council, even our training committee. So thank you very much for being here. So as I mentioned, we are going to be talking about this new guidance for revenue recognition. It is referred to as ASC 606, and it actually replaces virtually all industry and transaction specific revenue guidance. So it's a very lengthy There's a lot that falls under this new guidance, and we're going to dive into what's changed here in just a second. So I just want to mention the standard has a broad scope with very few exceptions, most notably lease contracts in the scope of ASC 944, which has to do with insurance entities, as well as guarantees. Some transactions involving financial instruments and certain non-monetary transactions. So very broad in scope. Leah, there is a lot of information to process under this new standard, but if you could please just give us a high-level overview of the new standard and what's changed.
Sure, I can do that. And I agree with what you said earlier about, definitely the clock is ticking for those companies that will be adopting the standard in 2018. And for the ones that, have not even thought about this, now is definitely a good time to go through the standard and make sure they're taking the necessary steps that they needed to do for purposes of adopting the standard. So this standard is principles-based, with the core principle being to recognize revenue that will depict the transfer of promised goods or services to customers in an amount that reflects the consideration to which the entity expects to be entitled in exchange for those goods or services. Okay. I know that's quite a mouthful.
Yeah, it really is.
But another way to think about it is rather than the focus on risk and rewards ownership approach, which was the one taken under the old standard, this new standard focuses on what was promised to the customer and when the customer obtains control of these goods and services that were promised.
Okay.
The amount and type of change will vary depending on the entity and its activities. Under the new standard, some companies will have differences in timing and amount of revenue, and in some cases earlier and in others later. Thankfully, there are around 70 examples in the standard that will help companies better understand the application of the standard. So I definitely suggest to companies to go through those 70 examples. I'm sure they'll find one that would apply to them.
And so where do you recommend companies go to find information on this guidance?
Well, there's several resources out there. A lot of the, auditing firms have some guides related to the standard. Of course, there's also FASB, the FASB website, right, and they can go to that website and download or get a copy of ASC 606.
Okay, perfect. So, all right, could you shed some light for us on how this new guidance should be applied and to whom it should apply?
Well, the guidance should be applied on an individual contract level, but it is permitted to apply it to a portfolio of contracts that have similar characteristics if the entity reasonably expects that the impact of using a portfolio rather than individual contracts would not result in materially different amounts.
Okay.
And that should be a relief to most of the companies out there. Then the revenue model applies to contracts with customers. And a contract is a party that has, or rather a customer is a party that has contracted to obtain goods or services that are an output of the entity's ordinary activities in exchange for consideration. If the counterparty is not a customer, then the transaction is not within the scope of ASC 606.
Okay, got it. Okay, so there is this 5-step model involved. Could we provide just an overview of that 5-step model?
Sure, I'll be happy to do that. The 5-step model, I like to think that, it's, I think it's something that has been discussed so many times in a course of probably the last 2 years. A lot of training is out there that talks about the 5-step model. And it really is, I believe, a good approach to the adoption of ASC 606.
Okay.
So the new standard involves, like you mentioned, the application of a 5-step model. And the first step is identifying the contract with the customer.
Okay.
And then you have to identify the performance obligation, determine the transaction price, allocate the transaction price to the performance obligations, and then, of course, lastly would be to recognize revenue as each performance obligation is satisfied.
Okay. So do you want to go into just a brief overview of all the different steps?
Sure. I don't know if it will be brief, but I'll try to do that.
Okay. And as a reminder, all of this information is available on the FASB website for a very detailed overview of this 5-step model. It is available there. So we do recommend that everybody visits FASB.org to get more information on this 5-step model. And yes, there is a lot of information that goes under this. So Leah, to the extent you can, be brief, but feel free to elaborate.
Sure. So going back to the 5-step model, as I mentioned earlier, the first step is really about identifying the contract. And so 606 indicates that the key elements of determining whether a contract exists are as follows. First, the collection of the consideration should be probable. The rights to goods and services and payment terms are readily identifiable. The contract has commercial substance, and the contract is approved and the parties are committed to their obligations. So those 4 key elements have to be met before the company can conclude that a contract exists. Notice that collectibility needs to be probable in order to proceed to the rest of the 5-step model. It is basically a gating question. If collectability isn't probable, then there's no revenue. And any amounts that were collected will be recognized as a deposit, and the contract would need to be continually reassessed.
Okay.
For most industries, this will not have an impact, but it may well impact real estate and healthcare entities.
Okay.
The collectability analysis is applied to the amount that the entity expects to be entitled to receive. For example, expected price concessions impact the amount of consideration expected to be received, and not necessarily the collectability question.
Okay, so what we're saying here is that this really applies only to healthcare and real estate?
Well, it applies to all companies, but the impact probably will be mostly with real estate and healthcare entities.
Okay.
Another question is whether and when the parties to the contract have legally enforceable rights and obligations. And this can present a difference from prior revenue guidance, where, for example, a fully executed contract may have been required before recognizing revenue, since the contract constituted persuasive evidence that the nature and terms of the transaction have been agreed to. Under the new standard, the contract may be oral, written, or implied. So that's one change.
Okay.
Similar contracts may actually have different results depending on the jurisdiction. Many issuers working on the revenue projects have found it beneficial to include a member of their legal team. Another interesting question may be whether contracts should be combined and accounted for as separate contracts. If there are separate contracts entered into at or near the same time with the same customer or its related parties, the contract may need to be combined.
Okay, so that falls all under the very first step of this 5-step model, which is to identify the contract. So let's move on to the second step, which is identify the performance obligations.
So as you mentioned, the second step is identifying the performance obligations. A contract may have promised to deliver more than one good or service, such as, for example, a sale of equipment, an installation, a sale of software, training, and post-sale support, or other items. The contract will need to be analyzed for, one, whether the goods or services are capable of being distinct, and whether they are separately identifiable in the context of the contract.
Okay.
To do this, you have two criteria. One is the customer has to benefit from the good or service on its own or in conjunction with readily available resources that are being sold separately by the entity or by another entity. An example would be a retailer selling a washing machine and installation services.
Okay.
Or with resources that the customer already has. The second criteria provides indicators that will help in determining whether the promise is to deliver a combined item, wherein the goods and services are really inputs into the final item, or whether the nature of the promise is to transfer each good and service individually. So these indicators center around whether the goods and services are highly interdependent or interrelated, or whether there are significant integration services, such as, a couple of examples that are mentioned in the standard. One thing to remember is that there is much judgment involved in applying the standard. If the goods and services meet both of these criteria, then they should be accounted for as separate performance obligations. Otherwise, they should be combined, and the company should continue the analysis until they have identified a distinct bundle of goods and services. As mentioned earlier, the standard has several examples that provide fact patterns that are helpful in thinking about your own facts and circumstances. For a series of distinct goods or services that are substantially the same, such as weekly lawn care, then the accounting would be as one performance obligation. So at least the board gave us some relief there. One area that may represent a significant change is on sales incentives, such as free maintenance services, loyalty points. And this can involve your customer or a customer of the customer in situations involving a distribution chain. Under the new standard, free goods or services are generally promised goods and services, which may be viewed as a separate performance obligation that will result to revenue being deferred until that service or good has been provided. Under current GAAP, many entities recognize all of the revenue when the original cost is sold, and they just accrue for the cost of the free good.
Okay.
Also, if you are in the consulting business and bill out-of-pocket costs, the treatment of these costs may be more complicated since they represent variable consideration, so be sure to check this out. This step should be done for each contract or portfolio of contracts at the inception of the contract.
Okay, so again, that has to do with the second step of the 5-step model, which was to identify the performance obligations. And so now we're moving on to step 3, determine the transaction price.
Yes, step 3 is the best part. It's all about getting paid.
That's right.
So the transaction price is the amount of consideration that the entity expects to be entitled to in exchange for transferring goods and services to a customer. This should be estimated at the contract inception and then updated at each reporting period. The price should be determined based on the terms of the existing contract, that is, without considering the possibility of the contract being canceled, renewed, or modified. And there are 4 components to consider with reference to the transaction price. You have to estimate the variable consideration, adjust the consideration for time value of money if there is a significant financing component.
Okay.
Consider non-cash consideration, which should be measured at fair value if such can be reasonably estimated, and determine how to account for the consideration that's being paid to a customer. For example, is this a reduction to the transaction price, or a payment for a distinct good or service, or a combination of the two?
Okay. All right. So that was step 3, and the best part, the part about getting paid, it's also the shortest part. So we'll move on to the 4th step, which is allocate the transaction price.
Under the new standard, the transaction price should be allocated to each performance obligation. This step comprises of 2 sub-steps, actually, and again, these two sub-steps should be performed at the inception of the contract. The first one would be to determine whether there is a standalone selling price. The standalone selling price should be an observable price from standalone sales of goods or services to similarly situated customers. For example, if you are a software vendor that provides technical support to your customers, then the observable selling price may be derived from renewals that are sold separately with regard to that technical support. If an observable price is available, then it is used to determine the standalone selling price. If not, then the company has to estimate the amount. There are no instances whatsoever in which revenue recognition is postponed because it is difficult to determine the standalone selling price. The next sub-step is to allocate the transaction price to each performance obligation, and this is done based on the relative standalone selling prices, again at the inception of the contract. If there is a discount, it is allocated proportionately to all the performance obligations in the contract unless there is evidence to suggest that it should be allocated only to one or more, but not all performance obligations. Also, if the transaction price changes after the initial allocation, then the change is typically allocated to the performance obligations on the same basis that was used at contract inception.
Okay, so that was step 4, allocating the transaction price. And now we are arriving at the last step of this 5-step model, which is to recognize revenue as each performance obligation is satisfied.
Yes, Caroline, we're finally at the last step. So one thing to emphasize is that the new standard is a control-based model. So basically, it requires the entity to evaluate at the inception of the contract whether control over the goods or service is transferred over time or at a point in time. Control refers to the customer's ability to directly control and benefit from the use of the asset. The concept of risk and rewards, which was under the old standard, is retained in the new standard only as an indicator of the transfer of control. The boards believe that it can be difficult to judge whether the risks and rewards of ownership have been transferred to a customer, so applying a control-based model may result in a more consistent decision about the timing of revenue recognition.
Okay, great. Well, thank you so much for that overview of the 5-step model. Believe it or not, that is a brief overview of the model, even though it seemed quite extensive, and you've provided a lot of great information, Leah. But again, we do recommend that everybody go to the FASB website for a very detailed overview, an extensive overview of this 5-step model. So just a couple of more questions for you, Leah, about this new guidance. The standard has several disclosure requirements that may be new for many entities. What can you tell us about disclosures?
Sure, I'll be happy to do that. And I do want to say that I agree with you that, the 5-step model is really just the tip of the iceberg when it comes to this. When it comes to ASC 606, there's a lot of guidance that's incorporated in ASC 606, and companies should definitely read through thoroughly the guidance. Mm-hmm. So going back to the disclosures, the guidance requires that revenue should be disaggregated into categories. And the disclosures should indicate, these categories, like the type of goods or service, the geography, the length of contract, any sales channels that are being used, the timing of the transfer of goods and services. So these could be similar to segment disclosures, but more granular. The entity should consider the type of information that is presented to investors, the type of information used by the chief operating decision maker, and the information used by the entity or users of financial statements to evaluate performance. The standard also requires that the company will need to provide a roll forward of the information about contract balances. I'm referring to the assets, liabilities, and receivables related to those contracts.
Okay.
In addition, the entity will need to provide information about the performance obligation. When these are satisfied, what are the payment terms, obligations for warranties, refunds, and returns, and the aggregate amount of transaction price that's been allocated to performance obligations that are not yet satisfied as of the reporting date. Any significant judgments should also be disclosed. SEC registrants should note that all annual disclosures, as well as the interim disclosures, to the extent they are not duplicated, should be made in each interim period in the year of adoption. This is because material matters not disclosed in the most recent 2017 financial statements should be disclosed in the 10-Qs according to Article 10 of Regulation SX.
Okay. All right. Well, thank you for that information. Now, ASC 606 permits entities to apply one of two transition methods. The first being the full retrospective or the second being modified retrospective. So would you give us just a brief overview of each of these two transition methods?
Sure, I'll be happy to do that. So as you mentioned, there's two transition methods involved. The first one is the full retrospective method, and this requires entities to apply the new guidance to each reporting period that's being presented. However, the good thing is that certain practical expedients may be applied. Now, those that elect the modified retrospective method would apply the new guidance only to contracts that are not completed at the adoption date and would not adjust prior reporting periods. I would presume that maybe a lot of companies would be, happy to apply this method.
Okay.
This seems to be, simpler than the former, although there are still challenges associated with such method, including additional disclosure requirements in the year of adoption. The company should carefully consider the needs of its investors and other users when deciding on the transition method to follow.
Okay, so in conclusion, we have mentioned this at the beginning of the podcast, but just to be crystal clear, when does this new guidance go into effect?
Well, for calendar year-end public companies, ASC 606 must be implemented no later than the first quarter of 2018.
Okay, so that's coming up very soon. So again, Leah, thank you so much for all that great information on this new guidance. It's a lengthy one, so we appreciate you condensing it down into some of the highlights. Before we wrap up, I wanted to switch gears a little bit to our This or That section. This part of our podcast has absolutely nothing to do with the topic that we've been talking about the whole time, but what I'm going to do is I'm going to throw two options your way, Leah.
Sure.
And give us your preference. Okay, so Malone Bailey, as everybody knows, is a Houston-based accounting firm. And the world knows that our very own Houston Astros are in the World Series. Tonight is Game 3. We are all very excited. Anyways, Leah, I know you've also spent quite a bit of time in Chicago prior to moving to Houston. So
yes,
where does your
correct.
heart lie? Are you a Houston Astros fan? Or are you a Chicago Cubs fan?
Well, first and foremost, I'm a Cubby, so but I'm happy that the Astros are in the World Series, and I'm really, really rooting for them. I've got my Astros shirt.
I know.
Right now.
I was gonna say, I know you're excited because even though your heart might be with the Cubs, Leah is wearing today an Astros shirt. So go Astros. Let's hope for a win tonight, right?
Yes, definitely.
All
Go
right.
Astros.
Go Astros. Well, thank you so much to all of our listeners for tuning in. And as always, please be sure to check out our website. That's www.malonebailey.com for lots of great information and resources. Thank you, and we'll see you next time.